Thank you very much. We're going to go into our first session, the economic reaction to the Russian invasion of Ukraine, led by Michael McKee, the moderator, for international economics and policy correspondent for Bloomberg Television and Radio. Thank you.
Thank you very much, and welcome to everybody who is joining us today in person and online. I am online. Unfortunately, I had high hopes of getting down to Sarasota. It's one of my favorite places, and I love the university itself because not only, Dr. Holbrook, do you have the great Bloomberg installation, but you have a great location, and I've been there a number of times and can't wait to go back and see your new buildings. I'm stuck in New York where it's kind of gray and it's been raining and cloudy, but in honor of the fact that it's so nice down in Sarasota today, I did wear my yellow tie to try to feel a little more spring-like. We're going to take a look first this morning at the economic impacts of the war in Ukraine, although I don't know that you can do that without bringing in all of the other issues that are before the overall economy. But we have some great people who are going to be able to address that this morning. Leland Miller is the CEO and co-founder of the China Beige book. He, more than anybody else, studies China very, very closely, and we are looking forward to getting his insights on where they are, why they are partnering with the Russians, and what they're doing about COVID. We're going to have to ask that because obviously that has major implications for what happens to the economy forward. Holly Wade is the executive director of the National Federation of Independent Business Research Center, and they keep track of all things small business, and we have seen a distinct drop in enthusiasm for the economy from NFIB members, and we'll get Holly's perspective on that. And David Berson is the chief economist at Nationwide Insurance. David and I go back a long way, and he has a very good perspective on the overall economy, including housing, which is a major deal for the economy these days. I want to start by quoting Martin Wolf, who is a columnist for the Financial Times, has been covering economics since, I think, the Roman times. And he wrote a column today about how much trouble the world is in, and that only gets exacerbated by the war in Ukraine. And here's his quote: "This war follows pestilence and threatens famine. Together, these are three of Ezekiel's four disastrous judgments of the Lord. Alas, the fourth, death, follows from the other three." Is it really that bad? Let's get started this morning. And we will start, I guess, by sort of asking each of the panelists for an overview of, in their area, where we are. Leland, you want to go ahead?
Sure. So, the best way to look at this, I think, is that in Washington, D.C., the Russian invasion of Ukraine has sucked all the oxygen out of the air, and it has changed everything that is happening inside the halls of Congress, inside the White House, and obviously has had dramatic changes to the international situation. Look, if you look at what was likely to happen before Russia went in, you had the Biden administration. They were a couple months away, after phase one had ended. There was time to present a USChina policy. It was time to present a new USChina trade policy. There were a lot of foreign policy things that had gotten pushed off because of COVID, because of Build Back Better and the economic recovery program Biden was pushing, that it was just time to start a more broader approach to how Biden views the world. And they had a couple of things teed up. They had some U.S.-China policy announcements teed up. They were deep into discussions on what the new trade policy would look like and how hard the White House thought it needed to push. It needed to push the Chinese, not just to have some sort of fair framework for moving forward, but also because the midterms are approaching in November, and Biden didn't want to look, politically vulnerable to attacks that he was being soft on China. So a lot of things were getting teed up right as Russia decided to misbehave. What this has done since is create an environment where just everything is shifted. So, China used to be priority number one. It's on the back burner now. There will be an announcement about a U.S.-China policy and a framework released sometime in the next 6 weeks or so, unless it gets pushed off like the other ones have. But China is definitely a priority level down. The administration is not worrying about the idea of Biden looking weak on China. They're worried about Biden being able to push this coalition against Russia. They're worried about inflation at home and abroad. So a lot of the big things that everyone thought were going to be the big priority issues and worries and concerns and political priorities for Biden in 2022 are just off the table or on the back burner. So we're in a position where the administration is going to be challenged quite a lot in the coming months to put together a broader idea on how they should be pushing back against non-U.S. allies, not just Russia but China. How do you push China? And this is really what it comes down to. How do you push China? How do you look tough on China while not creating a retaliatory spiral with China while you're trying to get the world motivated to stay united against Russia? So this is what the administration has been tangling with, and there hasn't been a reconciliation of these goals quite yet. But this is what their goal is, to try to hammer this out in the coming months.
All right, we're going to have to go back and forth with the mute buttons, so we'll all have the delay here that I have. I'm going to turn to Holly next and ask her why, in general, things look so bad from the perspective of the small businessman or woman.
Yes. Thank you. And it's great to be with everybody. Unfortunately, I am in DC. And yes, everything has turned to Ukraine in Congress, as Leland mentioned. For small businesses, though, we've been surveying a sample of our membership, around 300,000 small business owners, for the last 48 years. And so we've seen what it looks like in times of inflation in the late 70s, early 80s. And for most small business owners, they've never experienced anything like this outside of that little blip of inflation related to energy costs in 2012 was the last time we saw a spike in those business owners saying that inflation was their single most important problem. But looking at it right now, small business owners are fairly pessimistic. And the last drop in our optimism index, which is kind of the headline measure of the small business sector, the contributing factor to the drop was business conditions in the next 6 months, what their expectations are of business conditions. And they've soured quite a bit from last December. It has gradually declined, the index. And so we're noticing that small business owners are kind of trading one set of problems related to COVID and all those mandates and everything to inflation pressures. And as I mentioned, not many small business owners have experienced anything like this. So navigating inflation and navigating price increases have been a huge challenge for many small business owners. The Ukraine war has certainly exacerbated this, specifically for some industries than others. But as far as not being able to get key components or supplies in inventory that they're looking for, that's still an issue. But right now, it's mainly having to adjust for those higher costs, input costs for small firms, and trying to figure out the best balance of absorbing those costs. So that has been the huge challenge for small business owners right now. Still there are some that are saying taxes and regulations are their single most important problem right now. But inflation, the last survey that was released last month, showed that 31% of small business owners are saying inflation is their biggest problem and having to navigate that. And it's a little different for small firms because the owner is generally the person who has to navigate this, look to see how to absorb these costs and kind of shuffling around, kind of their costs. And they don't have a lot of time to do this because they're also trying to fill those open positions that have been vacant for a very long time. So it's a lot of challenges for small firms. That is likely the reason that their confidence in business conditions in the next 6 months have declined significantly to one of the lowest levels in the 48-year history of the survey.
Thank you, Holly. Now let's turn to David Berson for sort of a 50,000-foot view, because he covers the whole United States from the middle of the United States, Columbus, Ohio. They like to think of themselves as the middle of the world, I think, the Ohio State University folks. David, let me just ask you, I've been reading overnight a number of research reports from various Wall Street houses that suggest we could see recession even by the end of 2022. Are you that pessimistic?
I'm not quite that pessimistic, Mike. Note that I'm also wearing what I would call a maize tie, not yellow, with beautiful blue M's on it that I don't often get a chance to wear in Columbus. But as a proud Wolverine, I wear it wherever I can. So I've got some interesting charts that we're going to put up here. If we can go to the first chart, that helps answer the question. So there are four big economic themes that are going on right now. First, the economy before the Russian invasion of Ukraine was doing pretty well. We'd come out of the COVID downturn, and even though we're going to get a pretty weak first quarter GDP number, underlying strength of the economy is pretty good. Second, inflation clearly picking up and made worse by the Russian invasion of Ukraine. Bad thing, obviously. The most important thing, perhaps, is with the rise in inflation, we have the Federal Reserve tightening monetary policy. Well, they've just started to tighten monetary policy. They're at the beginning of what we think is a long tightening stream, and we're going to see interest rates go up significantly. And so my colleagues on Wall Street, who are looking for the potential of a recession, perhaps even as early as this year, we're not quite that pessimistic, get it from the Fed tightening and perhaps tightening too much. Let's take a look at a couple of the charts real quickly. So COVID, new infection rates have gone down. They've started to come up a little bit. But the important thing here is that state and local governments have reopened their economies because COVID is down, and that is boosting underlying economic growth. Next chart, please. One of the big impacts that we have seen from the Russian invasion of Ukraine is the spike in oil prices, but oil prices and other prices were already moving higher even before that happened, but this made it much worse. Next chart. And if we look at other commodity prices, this is wheat. Wheat prices have soared. Other commodity prices are up as well. Again, they were going up before the Russian invasion, but this has made it far worse. Next chart. What is the Fed going to do? The red dots are, and you can see two of them on there, are what the Fed expected itself to do when it came out with its own forecast in March. So the Fed expects that it will raise the federal funds rate up maybe to 2% by year end, maybe close to 3% by the end of next year. Financial markets, this is now about a week old though, expect far more tightening than that. With the federal funds rate, and we started at the beginning of March with the federal funds rate at 0, perhaps up as high as 2.5% by the end of this year, and maybe as high as 3.5% by the end of next year. And the big concern is if short-term rates move above long-term rates, a yield curve inversion, that has been a pretty good signal of recession. We don't have that yet, but if the Fed follows through on all the tightening that it wants to do, we could. Next chart. All right, here's where we are today. We've got the aggregate supply curve, aggregate demand curve for the economy, inflation high, economic growth pretty good. Now, what does the Russian invasion of Ukraine do? It is a supply shock. It moves that supply curve up to the left. What does that mean? Higher inflation and less growth. At the same time, the Fed is fighting inflation. It moves the demand curve down to the left. What does it do? It brings inflation down eventually, and it slows growth. The net effect of the supply shock and the Fed response to higher inflation is slower growth. Will it go below 0? I don't think it will this year. It could next year. I'm very worried about 2024. What will happen to inflation? Inflation is going to go up in the short run. It is now. But as supply chains heal, and ultimately they will heal, and we're seeing some signs of that now, and as the Fed tightens monetary policy and slows the economy, inflation will come down. Rapidly? Probably not. Soon? Probably not. But we're probably close to a peak in inflation, but growth is going to slow from here, and perhaps we'll see negative growth or recession sometime in the next couple of years.
Thank you very much, David. Now let's start talking about what's happening in the world and the impacts that we're going to see beyond what everybody has outlined there. I want to turn away from the war just a little bit here and sort of set a predicate on China. There's a lot of expectation that the Chinese economy is slowing tremendously because of COVID more than anything else. And there's an old saying that when an elephant falls, everything underneath gets squashed. JP Morgan Chase does a GDP nowcast for China and is now seeing 2.2% growth, which the U.S. would love. But for China, that's a very terrible outcome. So let's start with Leland and ask him if you can sort of fill us in on the Chinese COVID response, what it's doing to the economy, and what it will mean for the rest of the world's economy.
Yeah, it's been a very interesting time to be discussing the state of play in China's economy, because you have your baseline. Here's what the data have been saying in the first quarter. You know, we've got new data in April that coming in a couple of days. You know, here's the state of play now, but here's what might happen if. And the if is COVID, but it's not COVID outbreaks like it is the rest of the world. It's about COVID lockdowns, and this is really the important differentiator in China. Anyone who's reading the headlines can see that the lockdowns that are being pushed in China. It was Shanghai. It may be Beijing soon. We'll see. Are of a nature that no one's ever seen. I mean, we're talking about quarantine for weeks and weeks and weeks. People shut into not just their neighborhoods, but their apartment building. There's been problem with food and medical supply delivery. But really, it's put a giant question mark on the entire year. Had we not had this Omicron spread that may become something more and may become something economically worse because of the lockdowns that are on top of it, we were looking at a year in which the first quarter probably bottomed in growth. The most important dynamic was that the Chinese leadership, unlike every other year where there's a party Congress, and party Congress is of course this conference that twice a decade the leadership gets together. They either appoint the successor to the leader, or they appoint the heirs apparent. A very big politically sensitive year. Every other time we've seen a party Congress year, it's been just a monetary spigot opening, fiscal spending, boosting the stock market. It's just been a fiesta. And a lot of people went into 2022 expecting that, okay, 2021 was tight. It was difficult. There was a lot of de-risking by the government. But 2022 is a party Congress year. How could things not be better? There was never been any sign that the Chinese leadership wanted to go more aggressive in 2022. There's been some headlines in the last 48 hours that maybe they're reversing some of this, but it's been a very, very calm government response to slowing growth so far. What makes this so difficult again is that lockdowns can change all of this. So you have a question. First and foremost, if 20 to 30% of your population and up to 40%, 50% of your GDP is under some form of lockdown, even if you decide you want to push the button for a more active credit pivot, some more active monetary stimulus, can you even stimulate the economy under those conditions? So the question now is, how does China handle the slowdown in growth, which is going a bit differently than they probably thought a few months ago because of the Omicron spread and the lockdowns? And again, if they decide that they are in trouble, how are they going to respond from a policy side? I think this is why you're seeing all these headlines in the last, several days about how they're going to go big into property again, big in infrastructure spending. I'm not sure they're even going to do that, but it's been important for the government to send a signal that they do have a response mechanism in place. They do see the weakening of the economy. They are planning for some of these worst case scenarios, which could mean lockdowns not just in April, but in early May, mid-May, and even late May if things go negative and larger cities continue to get locked down. So right now, April 2022, I said a few weeks ago, was probably the most important month in China since January 2020. Well, now May 2022 is the most important month in China since January 2020, because we're really going to see not just about the spread of COVID and not just whether the Chinese leadership pivots on stimulus, but most importantly of all, does COVID zero ease up at all, or the lockdowns start capturing some of the bigger cities? In which case, you have 2 months of relatively low growth in China and a really difficult time getting things back up again from a stimulus perspective. So May is going to be an incredibly important month, not just for the economy, but for policymakers trying to figure out what direction to go.
If I could just follow up, Leland, we normally ask what effect will China have on the U.S., but I'm wondering in this case, how much does China need the rest of the world? And I frame that in the idea that the developed nations of the world, a lot of countries are sitting this fight between Russia and Ukraine out, but the developed countries of the world, particularly in Europe and the United States, North America, are very down on the Chinese for interacting as they are with Russia. Is this going to cause a problem for China going forward, or do they not care what everybody thinks?
I think they care, but it's a lower priority. A few months ago, I would have answered the question by saying that the Chinese economy for a couple of years has been an engine, has been pretty impressive in its growth, but it's been about industry. It's about manufacturing. It's been about production, exports, et cetera. And all the headwinds going into 2022 were going to suggest that, manufacturing is losing momentum. COVID stimulus around the world is easing down. So manufacturing needs to be less of a growth driver for Chinese growth in 2022, 2023. The problem they have here is that with the COVID lockdowns, retail is getting destroyed. Services are getting massacred. A lot of the parts of the economy that the optimists were hoping would start to normalize, 2-3 years into the COVID recovery, are now going back underwater because they can't get things up and running when you've got COVID, but more importantly, when you've got lockdowns everywhere. So more than ever, there's going to be a reliance on trying to export their way out of this. That doesn't mean big devaluation of the currency or anything else, but it means that the regular growth drivers that they'd like to be leaning on right now are not available. So they had no choice but to stay reliant on some of these, exports and production that they have for the last couple of years. But what's happening now with the war in Ukraine? Well, European demand is cratering right now. You've got a situation where a lot of the demand from Europe is falling off. COVID stimulus is worn off the United States. There's a question of whether we're going to go into a recession anytime soon, as David had mentioned. So you've got weaker demand. You've also got COVID affecting some of the factories in China from the supply side. So this normally very reliable growth driver in China is under severe pressure. They need all the exports they can get. They need all the friendships and allies they can get during this time where they don't have much else to rely on. But will they have it? And so this is one of the reasons that this slowdown is a bit different than anything we've seen the last several years. And these relationships in Southeast Asia and other ones that are getting pushed and pulled because of the Ukraine invasion, they're more important than ever for China in 2022.
We had a report this morning that the trade deficit for the U.S. in March blew out $165 billion negative up from 106. I'm wondering, Holly, let's start with you. How much does what's happening in China affect your constituency? I realize that we're not talking about a lot of companies that are huge exporters, some are, but imports make up a good proportion of what the U.S. consumer buys. So how does your group see it?
Yes, so we just released a survey related to inflation and asked a bunch of questions among our members about those sorts of issues, and about still 44% are saying that they're not able to access the supplies and inventories that they need, key components of their business operation. A lot of that likely has to do with China shutdowns and not being able to secure those inventories and understand when they will arrive at their business. So that's still a challenge for them in navigating that. And 77% for the inflation part of it, inventory, supplies, and materials 77% are saying that is a substantial part of their cost increases. And so it all is, a factor in how they're trying to navigate and what their experience is right now. Interestingly, 77% said substantially contributing to their increased input costs. And also 77% are saying substantial for fuel. And so the Ukraine part and China both are impacting small businesses to varying degrees. But they were still having to deal with, as was previously mentioned, higher fuel costs running up to Ukraine, and now it's just exacerbated. And so small firms, especially those who don't have a lot of options in kind of moving around with suppliers or have the time and energy, frankly, to try to navigate this, that would be more available to a larger, medium-sized companies. But I mean, everybody's affected or impacted by this. Small business owners, just because they're the ones who generally have to make all the decisions and spend an exorbitant amount of time navigating these challenges, is very specific to the challenges faced by small firms versus medium and larger firms. But again, just less than half are saying that they are still unable to access inventories and supplies that they need, and likely, a decent part of that is the challenges with China. But then the fuel costs and all of that, while it was increasing before Ukraine, it has exacerbated, as I said. And so still most of them are saying that that is a huge challenge, and a challenge in a number of ways. So whether they use fuel oil for the business operations, gas for trucks, but also dealing with employees, driving and things like that. And there's a lot of pressure now on employers to increase those pays so that their commute isn't eating up more and more of their paycheck. But also, doing errands for the business, as I mentioned, trucks and big things like that for, say, construction and construction workers. It's just a mess. And they're not seeing, after talking with their vendors or other suppliers that they might be in communication with, it doesn't appear that they think this is going to go away anytime soon. So they are continually adjusting. One interesting thing, we asked this question a number of years ago, is how often do you look to kind of adjust your prices of goods and services? And right now, it's a third of them are saying weekly that they're having to adjust prices of their goods and services. Before that, it was maybe a couple times a year, if that, maybe yearly, maybe every 5 years. But now it's ramped up so much that they have to, pass or absorb most of those costs through increasing their prices. But they're trying to adjust in all sorts of ways. So, increasing their prices, unfortunately, in the immediate term, lower earnings, but then trying to be more fuel efficient, and unfortunately for some, just having to cut out some of the products and services that they needed before, and adjusting business operations that way to soften the inflation pressures that they're experiencing. But they're very pessimistic when looking 6 months out, not thinking that things are going to improve, unfortunately. And and who knows what this looks like going forward. All the adjustments that they made, how much of that's going to continue on afterwards, or will they look more like pre-COVID, pre-inflation? Even last summer, when we asked about inflation pressures, it wasn't all that high. It was still in the single digits as far as their biggest problem that they're facing. But now it's almost a third saying that inflation is impacting their business. So it's a huge hurdle. We hear from small business owners every day about their challenges navigating these kind of two major world problems. And we're also even seeing we do ask, what is contributing? Is there a single product that's contributing to your increased costs? And if they're looking at inventory and supplies, and while it spans the gamut, there's still many who are saying wheat has increased in price for their input. But it's, it's wheat, it's chickens, it's ground beef, it's still paper towels, the whole 9 yards that are affecting them. But they're, it's a unique position for them having to navigating these challenges by themselves.
I suppose the good news is you can get hand sanitizer these days, which is one difference.
You can get all the hand sanitizer you want.
2020. David, the Atlanta Fed GDP Now forecast for first quarter growth, and the GDP report comes out tomorrow, is for 0.4%, which is the lowest if you leave out the pandemic recession months. It's the lowest since 2015. But a lot of experts say it's going to be trade related and inventory related, and consumer spending is going to show up as still very strong. And given what Holly is saying, I'm curious. Yesterday we had the Conference Board consumer confidence numbers come out, and while people said they thought their incomes would be lower going forward, their plans to buy things rose. And so I'm wondering how bad the oil shock in particular, the energy side of it, and the other contributors to inflation are going to affect the consumer.
That's a great question, Mike. The first quarter GDP number is going to be influenced to a considerable degree by trade and particularly by inventories. And if you look back to the fourth quarter, we had very strong growth in the fourth quarter because we had a surge in inventories. A much better way to look at GDP growth is look at it over the year. So the first quarter compared to the first quarter last year. And many other countries, in fact, emphasize GDP that way. And, if we get 0% growth in the first quarter, GDP is still going to be up by 4% from a year ago, which is pretty good. It's slower. There's no question the economy is slowing. Consumer spending is likely to slow over time. Income is good. May not be keeping up with inflation right now, but the job market is tight. Unemployment is remarkably low. Payroll employment month after month is strong and perhaps doesn't exceed the economist's estimates. But the economist's estimates have been pretty strong. So job growth remains just very, very solid. So income growth is strong. And as long as people have income, they're going to spend. Will they spend as rapidly as they did before? Probably not, but they're going to spend. How about businesses? Business investment spending, as parts are very strong, parts are not. Businesses are not building new factories, so structures not going up very quickly, but equipment, particularly things related to high tech, that spending has been pretty strong, and that's likely to continue. Perhaps with concerns about cyber, that spending will go up even more. So if you look at underlying spending in the economy, which is basically business spending and consumer spending, it's not bad. It's not the 0 to 1% that we're going to see in the first quarter. It's not the 5 to 6% that we saw in the fourth quarter, but it's probably in the neighborhood of around 3%, still above trend. It's still going to put downward pressure, at least for a little while, on the unemployment rate, and it's going to put a little bit of upward pressure on inflation.
To that end, we have a question from the audience, and I remind everybody, use the Q&A function on your Zoom, or you can turn in questions to Kelly Bush and the folks down at UCF. But David, let me just ask you what your estimate for inflation is for the coming year or two.
Well, right now, the 12-month change is about 8.5%. We think by the end of the year, we may see some healing in supply chains, and that may bring inflation, this is a 12-month change, down, all the way down to perhaps 6%. Now, 6% is darn high, but it's slower than we have right now. And if the economy slows more next year, we think it will, although probably not go into recession, and particularly if energy prices go down. And if you look at futures markets for West Texas Intermediate, the benchmark measure for crude oil prices for the U.S., markets are expecting modest declines in oil prices over the next year or two. That's going to put some additional downward pressure on inflation. So by the end of next year, we could see the overall inflation rate perhaps down to maybe 3 to 3.5%. But 6% or so by the end of this year is still pretty high, even if less than right now.
Holly, let me start by asking you your inflation forecast, if you've got one, and then ask, there's been a lot of question about whether Americans shift from buying goods, into more services. You've got a lot of service industries in the NFIB constituency, and have you seen that trend? Or as it seems to come up in sort of the data, are people just spending more on both at this point?
Well, when we ask about sales levels and if if their revenues are back to pre-COVID positions, many of them are saying, yeah, we're back there. Unfortunately for them, a lot of them are very frustrated about not being able to take advantage of sales opportunities that they're missing out on, whether it's because they can't access enough of their inventories or supplies, or they can't fill those positions. And again, the historic low level of those seeing that business conditions are going to improve in the next 6 months. I don't have an inflation prediction here, but they're certainly seeing no end in sight right now, and they are continuing to operate under the conditions of having to increase prices and thinking through the next 6 months of what that might look like. When we asked about whether they are planning to increase prices in the next 3 to 6 months in the latest survey or the inflation survey, a lot of them, I think it was around 30%, are saying that they're going to have to increase prices, 10% or more. So it's nothing that we've seen before as far as small business owners. And I think it's just their communication with, as I mentioned before, their vendors, those who they have contact with in operating their business. I don't know that, they would see any relief probably for a while because, they're small, they don't have economies of scale as far as accessing those inventories as fast as maybe some medium and larger businesses in their industry. But it's, they are bracing themselves for inflationary pressures, increased costs of their inputs, at least through the summer into next fall. Hopefully it starts easing up sooner than later, but with inventory supplies and fuel costs, which is a huge component for many small business owners having to deal with increased fuel prices, any relief on those ends would be good news for the small business sector. And again, just because the owner is having to deal with all of this at once and doing the best that they can in absorbing those input costs. But their main contributors are supplies and inventory and fuel right now. So it's a tough road for them.
Now, for years, the Chinese economy, Leland, has been focused on mercantilism, exports, and then they started trying to change it to more consumer-driven domestic purchase environment. Does this COVID outbreak and the war set them back in that? And how do they affect the Chinese economy's development over the next few years?
I think it does set them back, but I think that they were setting themselves back even before COVID hit. The reason this is so important right now is there are some very big structural things happening in the Chinese economy. Even if you're not watching China very closely, you know that to 2021, there was a lot of financial sector de-risking. In the middle of the year, there's something people call the Evergrande crisis, property sector de-risking. They're trying to stop all of this reckless credit expansion going into the property sector to just try to juice growth. There's Beijing for as long as if any of us can remember, has always been, setting out a GDP target, making sure they hit that target. And it's not necessarily real growth. They're, falling short halfway through the year and they just start building things. And so property has been this great growth driver for them in terms of hitting GDP numbers, but it's also been a very non-productive use of capital for them. They are trying to move away from that. And if you read party media, you listen to party pronouncements, they'll talk about the rise of the domestic, demise of domestic consumption, the rise of the Chinese consumer basically taking over as a growth driver going forward. But you got a real problem here, which is you can't just say, okay, consumption rise and it will rise. You have to structurally incentivize the economy to change. And so while they're doing these important things on the de-risking side in terms of ramping down this reckless credit expansion to juice non-productive growth, on the other side, when you're talking about do they have a growth driver like domestic consumption to rise up and replace it, what are they doing in order to structurally incentivize consumption? One thing they could be doing is to increase the value of the currency. So putting purchasing power in the pockets of households so they can buy more. They are not doing that. Right now, that it's depreciating, but it's been range bound for a while because the goal of the government is for stability. Stability. It's good for the party. It's good for the economy. So they don't want to toy with the currency in a big way, either direction. Another thing you could do is you could just transfer state assets to the private sector, the household sector. You give them more resources for which to spend and to which to purchase things. Well, they haven't been doing that. As a matter of fact, the last several years have been the exact opposite. It's been more of a centralization. It's more of a focus on empowering, state firms. So they're not doing that. They could be materially broadening the social safety net. On the margins, they're doing that, but not in a way that is able to counteract some very negative demographic headwinds they have, not in a way where people will look at their spending power and say, okay, well, the government's taking care of this. I can, instead of saving up money to put my mother and father and grandfather and grandmother in an elderly care facility, take care of them in old age. Now I can go buy another TV set. That's not the mindset. So structurally, the question's always been, are they incentivizing this transition to more domestic consumption? The answer has been no, 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 no. It's been clear in the data that retail sales have been weak. Consumption gauges have been weak. They're still weak. A lot of people forget, about the general trend here because they think of it as sort of a COVID dynamic, but it's much more beyond COVID. And as we emerge from this COVID era, there's going to be more and more pressure on the Chinese government to be creating this growth driver, to be empowering domestic consumers. The question is will they do any of these key things in order to push this transition? The answer until now has been no. And it's hard to see them doing any of these things in a big way in the near future.
David, let's ask about the U.S. and the Fed. We're decoupled from China. China's going the other direction, loosening some policies. Europe is sort of stuck in the middle. How much impact do you think the Federal Reserve tightening is going to have on the economy? A lot of concern about them moving until they break something, and yet interest rates, if they get above a neutral, Jim Bullard of the St. Louis Fed saying we go above neutral to 3.5%. Well, that's where the Fed started raising rates in 1994, and things were not too bad then. Is it really going to have a huge demand destruction component?
The Fed has to tighten rates by enough to slow overall demand in the economy. Otherwise, the impact on inflation is going to be small. And the Fed doesn't want the impact on inflation to be small. It wants the impact on inflation to be big. If you look back a number of business cycles, the Fed has successfully created soft landings where the economy has slowed but not gone into recession, and inflation has come down, I would say 3 times. Jay Powell says 4, but that 3 or 4. But we've had far more recessions than we've had successful soft landings. So if you look at history, will the Fed be successful in creating a soft landing this time, bringing inflation down, but not causing a recession? Well, historical record says the odds are against you. And if you look at the times when we've had soft landings, they've all been periods where we did not suffer from a negative supply shock. So when we've had these negative supply shocks, the historical record is very much against you. The Fed has had to tighten so much that we've gone into recession. I mean, the point is not to cause a recession. The point is to bring inflation down. But if inflation moves up by enough, if it is intractable enough so that the only way to bring it down sufficiently is to cause a recession, that's what the Fed has had to do in the past. We'll see what happens this time. I'm always hopeful. I hope that this is another successful soft landing. But if we continue to get supply shocks, COVID was the big one. The Russian invasion of Ukraine is another supply shock. The shutdown in China is yet a third supply shock. If we continue to get these supply shocks, even if they're not as big as the original COVID one was, it makes it far more difficult for the Fed to bring inflation down without having to raise interest rates by enough to cause a recession. I think ultimately this cycle will end, as they all do, with the Fed tightening too much. The question is it now, in the next couple of years, or is it farther out? Another thing that we've seen is that business cycles, the expansions, have tended to be longer over time. The longest expansion in U.S. history was the one that ended just, during the COVID downturn. If we hadn't had COVID, it would have been an even longer expansion. Will this one set up to be that? Again, I hope it is, but because of the nature of the supply shocks, I am doubtful. I think the Fed will have to tighten by enough in order to bring inflation down to cause that recession. Where does the federal funds rate end? In part it depends upon what long rates do too. That inversion of the yield curve where short-term rates move above long-term rates is a pretty good leading indicator of recession. But it's not the 210 that a lot of people in financial markets look at, the 2-year Treasury versus the 10-year Treasury spread. I'm a big believer, as I think the most members of the Fed are, that you have to look at a very short-term rate, the federal funds rate or the 3-month T-bill rate versus a longer rate, such as the 10-year Treasury. We're nowhere near inverting at this point. If the Fed tightens, let's say it brings the federal funds rate up to 2.5% this year, 3.5% next year, well, the 10-year right now is about 275. Does it move up further? Markets are pretty good at looking forward. Perhaps the 10-year doesn't go much above 3%. So if we get Fed funds next year at 3.5% and the 10-year is at 275 to 3, that's an inverted yield curve, and that's a real warning sign of a recession, perhaps in the second half of 2023, but certainly by 2024. So how much the Fed has to tighten will depend in large part on the behavior of long-term rates.
We have a question from the audience, so I'm going to pass it over to Kelly Bush there in the audience at the university, and she's got a microphone for our questioner.
Yeah, hey, Mike Scott Gray. Follow up to this, but it's a little bit longer term. Our U.S. national debt has now surpassed $30 trillion. We've had major impacts from COVID and now from Ukraine. What are the long-term implications of this national debt problem for us?
David, you want to take a crack at that?
I can certainly start at it. We've seen no real impact yet. The rest of the world is happy to give us their excess savings. Well, and as long as the rest of the world is happy to give us excess savings, then a rise in national debt here, while negative, isn't terribly severe. It means that more of our future wealth goes abroad, but only some of it. We can still grow rapidly here, increase wealth domestically, as well as sending future income abroad. But at some point, as the debt continues to grow and perhaps grows rapidly, does the rest of the world start to view us as, I hate to pick on them, but I will, as Argentina? Probably not Argentina, but do they become less convinced that we can always pay back our debts? If the rest of the world does start to believe that, even a little bit, it means interest rates here will go up, because in order to finance the debt, the annual deficits, you're going to have to give investors in the rest of the world a bigger return because they're going to be more uncertain. So at least for some intermediate period of time, not now, but at some point, and we don't know when, interest rates in the U.S. may be higher because of that, because we have to give higher rates of return to foreign investors. That's not a problem today, but if we keep raising the debt over time, it may well be a problem.
I know David Kotak would not be upset with the Argentine peso going down as long as he can be in Patagonia fishing. So maybe that is a good example. We have another question, but let me do a very quick follow-up to Leland. Because the Chinese have been the biggest buyer of U.S. treasuries. Are they still going to be interested? We're going to have a lot more treasuries to sell them now that the Fed is no longer going to be buying.
Yeah, you had years in which the Chinese were buying more and more and more. This has stabilized, even gone down a little bit over past years. But the main issue with this is that in a perfect world, no one in Beijing would want to be investing in dollar assets. They wouldn't want to keep themselves held hostage to the idea that the U.S. controls the dollar and the Chinese economy, the Chinese leadership, the Chinese political system, Chinese financial system is beholden to the dollar, and so they would like to sever that link and buy fewer treasuries. There's just nowhere else to put your capital. I mean, you can diversify. And I think what the world will do over time, you talk about, will the dollar ever lose global reserve currency status? Much broader question. But what you're seeing already and what will likely continue to happen is that there will be a little diversification at the margins, some money at the margins going other places, but fundamentally, there's nowhere else that has the criteria that the U.S. bond market has. So the Chinese don't like the dynamic, but there's not much they can do. So they're sort of trapped within the current system until another asset is created that provides the same level of protection and good governance and liquidity.
All right, we have time for maybe one more or two more questions. So Kelly, you have somebody there in the audience?
Hi, it's Roger Young. Question for Leland. The dollar yuan today is about 6.55. It puts it back to March 21 levels. Does this represent a strain for China in the euro dollar market? And what is the priority for the yuan in the eyes of the Communist Party?
I like that's the second part of that question a lot. So I'm going to start with that. The answer is stability, 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 stability. So if you look at what's happening, the dollar, everyone likes to talk about it. A lot of friends or FX traders, they like to look at how much the yuan has moved in the last couple of weeks, and it's something big happening. If you just expand your gaze to a broader 5-year, 10-year window, the yuan is relatively range bound. And it's range bound because it's a managed currency. It's a little bit of a float within a window, but it's a managed currency and it's managed against the dollar. What the Chinese government wants to do, and the Chinese Communist Party wants to do, is they want to piggyback on U.S. dollar stability through this by creating a parallel yuan stability. So you will see it move up and down based on dynamics in terms of the weakening economy at home, based on whether the dollar is being supercharged abroad. But what you'll see, and you'll also from day to day, from week to week, you'll see the government play some games in order to make sure that they're not sending out the signal that the yuan is a one-way trade for people to go in and try to make money off of. But by and large, what the government wants is stability, and so you're going to see this unless you have a break the glass type of economic emergency. You are going to see the yuan stay within a relatively normalized window vis-a-vis the dollar now and going forward.
All right, let me do a quick lightning round before we go here. I'll ask each of you to maybe answer in a minute or less, and I'll start with Holly. We have seen, I think everybody around the country has seen an awful lot of empty storefronts over the past 2 years. Now with everything going on and the uncertainty out there, is that part over? Is it going to get worse? Are we going to see more small businesses closing? Do we have people wanting to get back into business and maybe unable to because now interest rates are going up? What happens to small business?
Sure. So I think because of the census has a great program, the business formation statistics, and has shown a rapid increase in business formations and even, as they say, high propensity formations of those businesses that are likely or have hired one person so far. So those employer businesses. I think that this reshuffling of, whether you need a storefront or whether you can do this in some other way that isn't cost prohibitive. But, as walking down Falls Church here in Virginia, there's still a number of storefronts that are closed, especially in downtown. So I think there's a significant reshifting of where small businesses are located, if they're able to adjust their location, maybe to the suburbs where things aren't quite so bad. But those in downtown urban areas are having a really tough time because of, not as many people going downtown to work. And so a lot of those businesses has shut down. But because of the nature of small firms, that massive churn of ins and outs of businesses, I think that adjustment, will continue, and they're doing pretty well so far there. But with the increase in interest rates, many of them already took out a economic injury disaster loan that was 3.7% interest rate. Still maybe have even some of the PPP loan money that was supporting them, but also for the using their own earnings to reinvest in their business. That's their number one form of financing their firm. So I don't know that the increase in interest rates is going to contribute much, because they do have financial instruments that they're using right now to help support business. But, we'll see when all of that money starts running out that they've been sitting on, and how they'll adjust to a higher interest rate environment.
All right, Leland, let me ask you very quickly, less than a minute. We all know that the Trump administration was not very friendly to the Chinese, and the Biden administration has not really changed that policy. Where by the end of this crisis, whether it's 2022 or 2023, will U.S.-Chinese relations be?
I think it'll be worse. The last year or so, it's arguably been better. I'm not sure that the Chinese are very happy with what has been going on, but the Biden administration's been distracted and hasn't had a very tough crackdown on the Chinese on export controls or trade policy. And so you've seen this hiatus from interaction. Coming up, you've got the political midterms. Republicans are probably going to take over maybe both the House and the Senate. They've already got the a China plan ready to go in case the current China bill, competitiveness bill going through Congress right now fails. So I think that once we get into 2023 and we start heading towards the 2024 election, I think China is going to go back to the top of the list in terms of domestic, foreign policy priorities. And I think you're going to have the parties once again competing to be who's tougher on China.
We are pretty much out of time, but I saved the toughest question for David last. A lot of uncertainty about what will be happening by the fall. November 26th, Michigan and Ohio State. Who wins?
Both teams are going to be ranked in the top 10, and I suspect that at least one, perhaps both of them, will be undefeated on that date. It's going to be a tougher game. It's at the Shoe. It's not at the Big House. But I will go with Michigan, that Jim Harbaugh will pull one out.
All right. Well, we'd like to thank our panelists, Holly Wade, David Berson, and Leland Miller. And we'd like very much, again, to thank the University of South Florida and Dr. Holbrook for inviting us today. And we only hope the next time you do this, we'll all be able to be there in person. I'm Michael McKee. Thanks very much for joining us for this panel.